Alright guys, back with another video, diving into basic accounts. When a regular investor opens an account, it will be opened in one person's name, an individual account, or in the name of two or more people, which is a joint account. With individual accounts, an individual account has one owner. The account owner is the only person who can control the investments within the account and request distributions of cash or securities from the account. The owner or the court may add other people who may enter trades, but there is only one owner with individual accounts. When the individual owner dies, the account's assets are distributed through the owner's estate unless other arrangements have been made. And then you have joint accounts, and there's different types of joint accounts. In a joint account, two or more adults are named on the account as co-owners, each having control over the account. A few points to remember about joint accounts. You want to remember the account forms for joint accounts require the signatures of all owners. In a joint account, the owners are often called tenants. Joint account agreements provide that any tenant may transact business in the account. And with joint accounts, checks must be made payable to the names in which the account is registered and endorsed for deposit by all tenants, although mail only needs to be sent to a single address. A joint account must be designated as either tenants in common, TIC, or joint tenants with rights of survivorship, JTWROS. These designations determine how the account ownership will be handled if any account holder dies. Though there are other types of joint accounts, these two, tenants in common and joint tenants with rights of survivorship, are the most common joint accounts. How does each one work? With tenants in common, TIC ownership provides that a deceased tenant's interest in the account is owned by that tenant's estate and is not passed to the surviving tenant. Once again, interest in the account with tenants in common is owned by that tenant's estate and is not passed to surviving tenants automatically. Tenants in a tenant in common should have an agreement that says what percentage of the account is owned by each tenant. If no such agreement exists, it is assumed that the account is owned equally. So when a tenant dies, the descendants portion of the account is identified and is distributed through the descendants' estates. So always connect descendants' estates with tenants in common. As far as joint tenants with rights of survivorship, JTWROS, joint tenants with rights of survivorship ownership rules state that a deceased tenant's interest in the account passes to the surviving tenant. So TIC, tenants in common, passes to the estate, whereas joint tenants with rights of survivorship, interest in the account passes to the surviving tenant. All tenants in the account have an undivided interest in the account. meaning all tenants own all of the account equally. If one tenant dies, then the account remains the property of all the surviving tenants. This type of registration is very common for married couples. So if one dies, the surviving spouse may continue managing the account with little difficulty. And then you also have transfer on death. TOD, transfer on death, is a designation that an owner may add to an account that allows the owner to pass all or a portion of the account to a named beneficiary or beneficiaries at death. An account with transfer on death designation avoids probate. The transfer on death transfers the property directly. However, the assets in the account do not avoid estate tax. A TOD, transfer on death, may be added to individual accounts and joint tenants with rights of survivorship accounts. In the case of a joint account, the TOD, transfer on death, becomes effective after the death of the last surviving tenant. And then after individual accounts and joint accounts, you have accounts for organizations. Accounts for organizations, like businesses, are much like any other account. The biggest difference is that the owner might be a legal entity, like a corporation, instead of a natural person. So accounts for organizations, you have corporate accounts, where a corporation is a legal entity that has been organized for a purpose, usually to be a business. Corporations are run by a board of directors. When opening an account for a corporation, a firm must obtain a copy of the corporate charter, which is a document filed with the state that forms the corporation. The broker-dealer firm will also need a corporate resolution. This form is a resolution of the board that authorizes who may open and control the account. A new account form is needed for all new accounts. A corporate resolution must contain the business's legal right to open an investment account, an indication of any limitations that the owners, stockholders, a court, or any other entity has placed on the securities in which the business can invest, in the name of the individual who will represent the business in transactions involving the account. If the corporation wants to have a margin account, the corporation's charter must not prohibit this activity. Another type of account you may encounter is partnership accounts. A partnership is an association of two or more individuals. Partnerships frequently open accounts for business purposes. The partnership must have a written partnership agreement and an authorization from the partners stating which of the partners can make transactions for the account. If the partnership wants a margin account, the partnership agreement must not have language prohibiting margin. An amended partnership agreement must be obtained if any changes have been made. In partnership accounts, the assets are owned by the partners according to the partnership agreement. And if you see questions ever mention sole proprietors or sole proprietor account, a business that is organized as a sole proprietor is a business that is owned by one individual. An account open for a sole proprietor is effectively the property of the business owner. Just think someone that works for themselves is a sole proprietor. The account may have a business name associated with it in addition to the owner's name. Most firms will have an additional form to add this other name called a fictitious business name to the account. Checks deposited into a sole proprietor account could be made payable to the account owner or to the business name. And then here it's important to know some information about trust accounts. What is a trust? A trust is a way to hold assets for a special purpose. Customers form trusts for many reasons. The most common reason individuals and families form a trust is estate planning. Now, there are three aspects of asset ownership: owning the asset, controlling the asset, and benefiting from the asset. These three aspects may be assigned to different persons in a trust account. A trust is a way to hold assets that allows for greater flexibility in assigning different aspects of ownership. What are these aspects of ownership of a trust? Some aspects of ownership are legal possession, where the person who owns the asset is often called the grantor, has legal possession. And then you have management ownership, where the person who controls the asset is often called the trustee, manages the asset. And the third aspect of ownership in a trust would be benefit, which is the person who benefits from the asset is the beneficiary. The trustee of a trust has a fiduciary duty to manage the trust for the benefit of the beneficiary of the trust. A trust that is created and funded by the grantor during the grantor's lifetime is called a living trust. On the SIE exam, questions about a living trust are much more common than questions about a descendant trust. The same is true of trusts. Living trusts are much more common. Depending on the trust, the grantor may be able to make changes in the living trust during their lifetime. And you want to know the differences between a revocable and irrevocable trust. Most living trusts may be modified or even completely revoked by the grantor. Such trusts are revocable trusts. As long as the grantor is alive, the trust may be modified as the grantor sees fit. As long as the grantor has this level of control, the assets of the trust are still considered part of the grantor's assets and will be included in the estate. In a revocable living trust, it is common for the grantor to also be the trustee and the beneficiary. As far as irrevocable trusts, when a grantor forms a trust that cannot be modified, it is an irrevocable trust. Assets placed in an irrevocable trust may be removed from the grantor's estate. The grantor gives up control of the assets in an irrevocable trust. For the assets in an irrevocable trust to be removed from an estate for estate tax purposes, the grantor may not serve as a trustee or be the beneficiary of the trust. Next, you have accounts for minors, known as UGMA and UTMA. UGMA, Uniform Gift to Minors Act. UTMA, Uniform Transfers to Minors Act. Accounts that are set up for minors, custodial accounts, can be established under the Uniform Transfer to Minors Acts, UTMA. These accounts require an adult to act as a custodian for a minor, and the minor being the beneficial owner of the account. Many kinds of securities and cash may be held in a custodial account. Any assets given to a minor through a UTMA, UTMA account are managed by a custodian until the minor reaches the age of majority. You want to note that the age of majority varies from state to state, so the exam will not expect you to know the actual age. The custodian has full control over the minor's account, and the custodian can buy or sell securities. The custodian can exercise rights or warrants, and the custodian can liquidate or hold securities. The custodian may also use the property in the account for the minor's support, education, maintenance, general use, or benefit. However, the account is not normally used to pay expenses associated with raising a child, because that's normally just a parental responsibility to raise your child. So you wouldn't use UTMAs to do that. A few key points regarding UTMA, UTMA. An account may have only one custodian and one minor or beneficial owner. Only an individual can be a custodian for a minor's account. A minor can be the beneficiary of more than one custodial account, and a person may serve as custodian for more than one account, as long as each account benefits only one minor. So one adult, one minor per account. But a minor can have multiple accounts open for them, and an adult can open multiple accounts. A donor of securities can act as a custodian or can appoint someone else to do so. Unless a parent is acting as a custodian, the parent has no legal control over a custodial account or the securities in it. And a minor can be the beneficiary of more than one custodial account, and a person may serve as custodian at each account benefit. And the rules that apply with UTMA, those same rules apply to UGMA. The only difference with UGMA and UTMA, a difference should be that UGMA only holds financial assets. UTMA can hold basically everything for a minor, whether it's financial assets, physical property, vehicles, art, anything of value can be transferred to a minor with UTMA. Another account you may come across for minors would be a Coverdell Education Savings Account. Coverdell Education Savings Accounts, Coverdell ESA, also called Education IRAs, allow after-tax contributions up to $2,000 per student per year for children until age 18. The maximum contribution allowed is reduced and eventually eliminated for higher income taxpayers. Growth in income within the portfolio are tax deferred, and there is no tax deductions for these contributions. Coverdell ESA is not as popular as the Section 529 plans due to the rather small contribution limit, as well as the limits on a contributor's income. 529 plans have no income limits. When it comes to fiduciary and discretion, always remember fiduciary is a good thing. It's a trustworthy capacity. A person legally obligated to act in the client's best interest is acting in a fiduciary capacity. And discretion allows a broker-dealer to trade without asking the client first. Discretionary authority requires written power of attorney signed by the client. So you have full power of attorney and limited power of attorney. A full power of attorney grants the appointed person the power to deposit or withdraw cash or securities and make investment decisions for the account. The person appointed full power of attorney has much the same power over the account as the owner of the account. It would be highly unusual for a registered representative to have full power of attorney on a customer account that does not belong to a family member. And then you have limited power of attorney, where a limited power of attorney allows the appointed person to have some, but not total control over the account. The document specifies the level of access the person may exercise. Limited power of attorney, also called limited trading authorization, allows the attorney to enter, buy and sell orders, but not withdraw assets. Limited power of attorneys are more common than full power of attorneys. So, easy way to remember, full power of attorney allows withdrawals. Limited power of attorney, there's no withdrawals allowed from the person granted that power.